Hello, guys. Good afternoon for everyone who joined. Thank you for your time. So before I start, I would like to introduce that this is our Buoyant Mobile 3Fs community. If you're interesting, you can join lah. And inside we have shared a lot of insight news, market news, or economic trend. So you all may join inside and discuss with each other what's your thought about the market. Okay. So this is our US Asian market, trade US market from 9 a.m. So this is our community group, same. Okay. Also, we currently have our trade US market from US dollar $1.88 flat, and there's no hidden fees. We don't charge platform fee or settlement fees. What you see is what you pay lah right now. US. So I would like to introduce myself, and I'm Kian Chong here, equity specialist from Toa Payoh branch, PIC. And today my webinar is the topic is mastering contract for difference CFD trading from 3 p.m. to 4 p.m. All right. So my content outline for today would be what is CFD, type of CFD instrument, how to trade CFD, and also value added and some sharing for you guys. All right. So what's our contract difference? So contract difference, basically, we can call it as derivative products, which is traded on margin and traded over the counter directly between the trader and the CFD provider without the exchange and as the intermediary. Okay, it is an agreement to exchange the difference in price from the time the contract is open until the time it is closed. So prices of CFDs are derived from the underlying assets that they are linked to. So it also allows customer to participate in the price movement of the underlying asset without owning or taking physical delivery of the underlying assets. Also, is mainly offered as the market maker or direct market access model. So go back to the one that without owning or taking physical delivery of the underlying asset, which is like, for example, if you buy a share under contract for different CFD, for example, I buy an Apple shares. I don't really own the Apple shares. It's just a contract, which I just own a contract. I don't really own the Apple share. So when I open a long position, then I don't really own an Apple share. When the price goes up, I will earn from the different. So oppositely, if your price goes down, then I will lose the money. The just the price of the difference. It's just a contract. This is the main difference of CFD and the equities market. Okay. For the next, so this is what I mentioned just now is a derivative product traded over the counter. Buy or sell, you can buy either buy or sell or short sell, and you do not own the underlying assets. Is a contractual agreement, which is the contract, and the opening hour is same as the equities. All right. So for underlying, stocks market is under the equities, but CFD is respective assets. So leverage for stocks, you don't have a leverage for if you trade on stock market, but for CFD you have. For short, yes. For CFD you can short. For stocks equity, you are unable to short. So it's actually for the ability to short. Right now, for Singapore market, we can short, but for US, we still cannot. So if you are interested to short US market, you can use CFD as a product to short the position. So for the last thing is financing charges. This is one of the disadvantage of what I can say for CFD, which is the financing charges, which is charged day to day. So the advantage of CFD, you have two directions. You can either long or short. And also we can leverage and margin up to 10 times multiplied by 10 or 20, maximum is 20. Yeah. So also under CFD, you have multiple asset classes, which is you can trade on not just stock market, you can trade index, and also you may trade for commodities as well. And also the one last thing is you can hedge using your CFD position. Okay, so you also have to take note that leverage can be a double-edged sword as well. All right. So let's come to the example for the explanation for two direction. So for two direction, long and short, CFD allows you to go long or short. Based on the chart, you can see if you predict that the market is going up in the near term, you can open a long position for your counter. Let's say for example, it's a index S&P 500. So when you predict that it goes up, then you long. And then second, you predict it's going down, then you short, long, short, then you might earn in every different part. For I go for Mr. Mohandi Pillay. So you miss your point. CFD for US market or for both. CFD can trade for both US and Singapore market. Okay. So I go for a Q&A for a while for Rosma Manso. Are there specific guidelines for beginner entering the world of CFD trading? Guideline or recommendation? The work of CFD. Maybe you can listen to my webinar this session first. After that, if you have further question to ask, you may try to ask again. Because for this session, it's actually for beginner. For right now, what I'm going to present in the next few slides on this whole session is actually for beginner. It's quite good for beginner to know about the face of the CFD, what I can say. Okay. All right, so I continue first. Okay, so for providing you the opportunity to profit trade in both bull and bear market conditions, and short sell occurs without the trader having to borrow shares, and there's no penalties or no buy-in. Unlike SGX. SGX, if you short sell, they are required you to buy in for on the next day, or else you have to borrow share from your broker. So yes, we have provide the borrow share facility for our client, but you are required to put in a 30% of collateral when you borrow share to do a short position. But CFD, you don't have to do it. And if you don't borrow share, you would like to open a short, the next day SGX will ask you to buy it, no matter how, or they are forced buy it. If they are unable to buy, then they will penalty those clients who open a short position. So for Gina Y, can I press my share to trade CFD? For this inquiry, we cannot press share to trade CFD, only cash. Okay. All right, so I come to the next. For leverage and margin, CFDs are traded on margin, as I mentioned on my previous slide. So this means that the trader is able to use leverage to take on larger exposure with a smaller initial deposit. Leverage has the effect of amplifying both return and losses. For example, you look at this Amazon, you will need to fork out 14,000 to buy 100 share of Amazon at 140 US dollar per shares. So for Amazon, as a CFD is offered at 10% margin requirement and leverage for 10 times, the maximum leverage for Amazon from our platform is 10 times. So with CFD, you are only required to put up to 10% of the contract value as an initial margin to buy 100 contracts of Amazon. So This is equivalent to only 1,400 US dollar, which is about 1,900 Singapore dollars to purchase up to 100 shares of Amazon. So let's look at this table. If price of Amazon rise by 20%, from $140 to $168, which is about 20%. So your gain will be 2,800 if you leverage up to 20, leverage up to multiply by 20. So it's about 200%. So in the opposite way, if it's fall by 20%, which is the price from $140 to $112, you will lose up to $2,008 as well as you times 10. Sorry, it's 10. Just now the example. I have wrong already. So 20% I multiply by 10. So it should be a loss of 200%. Okay. So this is the chart. You can see the difference. So the orange bar is actually the return on initial margin, and the silver one will be the change in the price of our margin price. So when you look at the silver bar, it's just a little changes. It's just a small chart, it's just a small bar, but you look at the return is much more, compared with the silver bar, it's much more longer than the silver bar, which means that the effect of CFD is really on the return. It's really helpful for you. But also leverage can be a double-edged sword, as what I mentioned previously. Okay, so I go to the second topic, second outline, which is the types of CFD instruments. The first one would be equities. Equities, you can trade as a CFD or CFD DMA. So in the next few slides, I will talk about what is CFD DMA. So also we have commodities. Commodities include oil, gold, and silver. So for indices, we do have US indices, Singapore indices, Hong Kong indices, even Japan, we do also include have lah. So for example, like US S&P 500, US Tech 100, or Wall Street Index. So the last one will be the Forex. So for equity CFD, you can access up to 8 global stocks exchange, which is over 1,200 counters of Singapore shares, the largest number of counters available for shorting. So for Malaysia, we have up to 250 counters, Hong Kong, we have 800 counters, and for China, we have 600 counters. So Japan, 200 counters, and Australia, 200 counters. So the last two will be the UK market, which has 90 counters, and the last one will be US 1,500 counters. Okay, so for EQ, when you do a CFD trade, when you search on the stock, for example, DBS, Singtel, or SIA, when you search out there, it will come out with three different, what we call it, is three different categories. So once you search DBS, for example, right now, the first example, there will one be a blue color tag with EQ. EQ means that it is equities. For CFD, contract for difference. DMA is CFD, direct market access. So if you want to trade CFD, you can choose the second one, which is the tag with CFD one. So for the cash settlement, for equity CFD, use cash settlement as well, and it's mirror cash market price movement. And one of the good thing from us is we don't have any additional spread for trading CFD, stock CFDs. What I can say, we are totally mirroring the price of the equities. All right, so let's come to direct market access. So it's a SGX share. Orders will be filled on the actual exchange and participate in the exchange order book. We will send the order to DMA order to the exchange based on the last done price, not bid or ask price, unlike CFD. CFD is based on the bid or ask price, but for DMA, it's based on last done price. So commission rate will be higher for DMA compared with CFD. All right, this is what the flow you can look at, comparing CFD, DMA, and CFD. So the one of the main difference is CFD, DMA. You have to always remember that it's trade on market liquidity and order book of the exchange. For CFD, we Philips are the market maker. Your orders come to Philips only. Therefore, you can enjoy lower commission rates. So what you can see in the first thing is Philips sends your order for DMA order. Philips send your order to exchange. Order is executed on the exchange, and the trade status reflected on trading system. This is confirmed. We will send your order to the SGX exchange. But however, for CFD, your order may or may not be reflected on exchange. So for CFD order is filled by PSBL based on bid and ask price, since the order is sent to us and we are the market maker. So your trade status will only reflected on the trading system of PSBL, which is Philips. Okay. So let's come to the calculating of profit and loss for example, for a long position. Let's say you long 10,000 share of stock A at $2. The stock price is $2 right now. You long, and the stock price go up to $3. The profit will be 10,000 because you earn about 50% since $2 to $3. So 3 minus 2, which is $1, $1 times 10,000. So your profit will be 10,000 US dollar. So for stock price, $2 and it goes down to $1, you are lost for 10,000 because it's go down by $1. So for short position, if you short 10,000 share of stock A at $2, it's go up to $3, which is opposite direction with your prediction, your positions. Then you will lose 10,000 since your position is $2, but it's go up to $3. So minus 1. So times 10,000 units, you have the share. So your loss will up to $10,000. So for stock price, if it goes to $1, so your position is $2, and same way you minus by 1, and you will earn up to 10,000. So let's go for commodities. Commodities are part of our everyday life. Well, I can say like raw material we use in our daily life, like metals, energy, or agricultures. So access frequently traded commodities. Gold, what I can say, gold, silver, and oil is the most traded from the investor. Most of people will trade these three commodities in the market. So for commodities, there's no expiry and margin is as low as 20%. And this is one another good things for us is that we do have the mini contracts available for client to trade. So for example, for gold, we have a mini contract of USD1, gold USD1 up, and this is the mini contract. If it's not a mini contract, then it will be up to gold USD 100, which is times 100. So you can look at the trade tab here. If the gold USD1, the market price right now, if you want to buy at 1,800, since it's a USD1, so it just times 1. And the value, the gross contract will be 1,800 US dollar only. So the margin requirements is 20%. So you only need to put in $493 Singapore dollar, almost there. Okay. So for gold 100 US dollar, you can see that if you buy 1 unit of the gold in a one contract and if our times up to 100, the gross contract value will be 180,000 US dollar, which means you have to put up to 49,000, which is about 50,000 around there, since it's a 20% of the contract, 50,000 of Singapore dollar. All right, so it's typically measure the performance of basket of securities. and representative chart of the markets like Amazon, Google, Meta, Disney, and Apple's. So indices CFD have multiple contract size globally, like sorry. Yeah. So these the indices that I gave example just now, like Singapore index, 20 Singapore dollar, Straits Time index, S&P 500 index, Australia index, US Tech 100 index, and Hong Kong index. There's still more. Like what I mentioned, there's a Japan index we do provide for client to trade as well. Okay, so indices mini contract, well, you can see same as the one that we show in the previous one, the commodities one. So if you buy the mini contract, S&P 500 USD 1, then it's just multiplied by 1. So what's the main difference for indices and commodities? For indices, we do provide a multiplier 20 of initial of a leverage. So if you buy 20,000, you only need a 5% initial margins. Like for this example, if you buy one in indices of US S&P 500, for example, the price is in 4,300. So times 1 4,003, you only require to put in about 300 Singapore dollar to open indices positions, S&P 500 positions. So if times 5 S&P 500, it will be $21,500 since it's time 5 lah, contract value. So the margin requirement is 5% only since it can leverage up to 20. So it's about 1,400, 1,500 Singapore dollars. So let's look in the specification. For example, for index for STI, Straight Time Index, Singapore dollar 5. So this is not a mini contract, this is a normal contract. So times 5, value of one index point times 5 Singapore dollar. So the contract size will be the times $5 times the price of index times the quantity. So let's say the target spread is 2.6. Okay. Your initial margin is 5% because you can leverage up to 20, and your maintenance margin is 5% as well. So for example, assume STI is currently at 3250 points, and your target spread is 3.6, right? So the target spread, if you minus 1.8, or CFD, the bid price is minus 1.8, and the CFD ask is you have to add up for 1.8 lah. Yeah, so for Mohan D. Pella, yes. Yes, I will send you the slide later after my webinar. Okay. All right, so let's look at the Forex CFD FX. So when we enter a buy or sell trade, we are referring to the base currency. And opposite transaction take place in the terms currency. So let's understand the quant. For example, GBP per USD is equal to 1.3. This means that one Great Britain pounds can be exchanged for 1.3 US dollars. So let's look at the next one. If the Great Britain pound per USD is equal to $1.45, it will be, this means that one GBP can be exchanged for 1.45 US dollars. So based on this quotation, profit and loss will be reflected in the terms currency. So which means the easiest way for us to remember is that you always look at the behind one, the terms currency. So when you do the trade, when you, let's say, for example, you do a Great Britain pound per USD, every profit or loss, you will reflected in US dollar, the behind one for this example. Okay. Okay, so for trading in Forex CFD, you are able to access to more than 30 major global Forex pair. For what we currently people use is the US dollar, European, Great Britain pound, JPY, and CNY. So you can track the performance of underlying spot forex. Also for forex, actually we do have a margin as low as 5%, which is you can multiply 20 leverage. So minimum contract size would be of 10,000 base currency. All right, so the next outline would be how to trade CFD. Okay, the first thing we will look at is the commission, talk about the commission. This is applicable during the, how we charge the commission is applicable during the opening and closing of CFD positions. So whenever you open a position, no matter buy or sell, then there is a charge for the commission on it. And when you close a position, then we'll charge you another times. So when you have a position, you open and close, there will be a two-time charge, same as a normal trade for when you trade at equities market. So the next will be commission for equity CFD. Trades are charged based on the total contract value of the CFD. This one will be the same. If let's say the position you open is the value is 10,000, then the commission will charge based on the $10,000 value of the contracts. Okay, so for equity CFD trades done on the same day for the same counter and will be charged on an amalgamated basis. So equity CFD only for this, you all have to take note on this. Equity CFD is for like those stocks CFD only. So for example, if you trade the local share, Singapore share, if you trade a SIA, for example, you open a trade on SIA for 100 units this morning. After that, you think that the SIA have a potential to go up further. After that, you take another decision that you would like to open another 100 units of SIA. These two trades will be charged on amalgamated basis, which means we only charge you one time. Both buy order cannot be buy and sell, but be a same direction, same way, and same counter, which is same action as well. Cannot be one buy, one sell. Must be two buy or two sell. Okay. So for commodities and indices, CFD are charged on per site or per contract basis. So the one last thing is that commission is not applicable for Forex CFD trade. So which means for Forex CFD is we don't charge any commission on it. All right, for Nina Josgan, what is the swap points adjustment when I hold a pair overnight? So for the swap point, what is the minimum make sense for checking? Hold on, let me read through the question first. So for the first question, the swap point adjustment. For the swap point adjustment, I cannot give you a specific answer first, as I need to check because for every different pair, we do have a different swap point. So maybe I'll email you later on details on what's the adjustment when you hold a pair overnight, because every pair will have a different swap points. Okay, so for the second question, the minimum contract size for Forex pair would be this. Contract size would be this. Minimum contract size is 10,000 of the base currency. Cannot for CFD trade, can be trade partially executed. You mean you want when you open a position, you close partially, or by what do you mean? If you open, if you mean you open 1,000 of the shares, you trade equities. If you open 1,000, you want to close partially like 500 units. Maybe can you specific? If for partially you close partially, then no problem for that. You can close partially. Okay, so I continue my slide first. Okay, so let's come to the next, which is the financing charges. For CFD position that are held overnight will be subjected to overnight financing charges. So accrued on a daily basis and will only be realized upon contract rollover or liquidation of CFD positions. So open for commonly asked question from most of the client would ask if open and close within the trade day, which is the same day. If you buy this morning and you close on afternoon before 5 p.m., then there's no financial charges as long as your position closed within a day, within the same day. If you place an order, yes, it would be partially done because when there's a bid and ask, hold on for this, if you hold, should be done. For this one, I need to check first with my end because I do see before there's a. I check first and I'll email you. I'll email you on directly on this. No problems. Let me check first for this. Quite interesting question. So I'll continue my slide. So on how to calculating the financing charges. So the financing charges will be the total market value of CFD position marked to the closing price of the day multiplied by finance rate for the CFD contract and divide by 365 since the year of 365 days. So come to the example. If you open one long CFD and close the position on the 3rd May, okay, so you entry at the day one. The price closing at 1,000 and you hold until day 3. Day 2, the price 1,200 and you liquidate at day 3. The contract value goes up to 1,300. So your total financing cost will be the first day 1,000 times 5.25% because our financing rate charges is 5.25%. This one will be subject to change and divide by 365. And this is just an example. Maybe the rate will be different already right now. It's not 5.25, no, I'm not mistaken. So you hold until the day 3, but day 2, the contract value already 1,200 times 5.25% divided by 365. So it will be 0.14 plus 0.17. So your financing charge on you for this contract will be $0.31. Day 3, there's no financial charge since you already liquidated the position. So we won't charge you anything on the 3rd day. Okay, so you can use CFD by buy, sell, hold the position, also scalping on the position or self-developed trading strategies. All right, so for buy and sell, hold, you can have less initial capital outlay. As per what I mentioned just now, you can leverage up to 20 multiplied by 20, and you are able to attain higher exposure, aiming for dividends or capital appreciations, and also believe that the company, if you believe that the company, the counter will do well or is underperformed. If do well, then you long for the company. If it is underperformed, then you just short sell on the company. So for scalping, it's something like day trading is a day trading. You see the chart, you're earning off the small price changes. Like when you entry at the price, top price is $41.50. 5 minutes later, it goes up to $41.55. You take profit straight away because earn that 0.05 and start all over again. You can keep on doing this way by looking at the mini chart because you see that if it goes up, maybe morning, the time the market has crashed, but afternoon when the market is starting, you believe that the market will recover. So you long on positions within the day, so which you are earn the differences between the morning and afternoon. You don't think that this 0.05 is really less, but if you open leverage up to 10, multiply by 10, you'll be quite a lot actually. So by develop your self-trading strategies, you can have a unique self-developed strategies, mixture of indicators and candlestick. You can look at a candlestick like you have your own candlestick like head and shoulder, cup and handles, or like a big bar candle, green candle, then you have long positions. Okay. So the last thing is hedging. You can hedge using CFD as well. Depends on if you want to hedge fully or hedge partially. So for hedge fully, you can open up positions, opposite position for the same counter activity. So let's say right now you have equities, you hold DBS, you hold a lot of DBS, 1,000 unit of DBS for long terms, maybe since 2 to 3 years ago, you already buy DBS. You believe that DBS goes up for after 10 or 20 years. But recently, US announced that they are going to cut rate starting on this year or starting on June, maybe June or September. A lot of analysts predict that US is going to cut the rate. So when you found that this news has come out, you read that the banks, because the interest is going to go down, right? So normally banks price are slightly affected by the announcement. You think that it's going to go down and you don't want to take the risk. You would like to hedge the risk, expose the risk. So maybe you can open your CFD position in a short position since you already have hold a share of DBS. So you maybe can open up a short position of DBS for a short term because you think that bank would be very risky, will be very volatile in this year, 2024. So you don't want to have any risk involved, maybe so you can open a short of DBS. So when even DBS go down, from your stocks market there, your equities of your DBS values go down, you lost money. But from CFD here, you earn from the short positions. So you can cover the one that you lost in the value. This is how you use to hedge your current position. So even you don't want to hedge fully, maybe you can consider to hedge partially to open an opportunity for a correlated instrument like STI CFD. As we all know, when market is good, the stock market is good, you have a lot of share, you hold a lot of share, basket of share in your holdings right now. You think that whole market is really going to be very good. And normally gold price run opposite with the stock market actually, as we know. So for example, you are going to predict that market for this year is going to very bad as well for like last year, then you can maybe open up a gold position. So when markets go down, your share values all drop a lot, but actually your goal is indices. It may help you to hedge as well, hedge partially, because gold may go up as well, goes adversely. So when stock market goes down, your goals go up, then you won't be a loss that much as if you don't hedge up, because this is what we call a hedge partially. Also, you can hedge with ETF like SQQQ. Okay. So take on investing. You can have a good stop loss. Always have a stop loss for your trade and don't open too big positions. Because if you invest more than what you can lose, then it might affect your decision when you're doing a trade. And also don't be emotional in doing trade as well. Don't overtrade and do not that leverage can be a double-edged sword. Which if you open the leverage multiply by 20, you might cannot afford the losses when you open the positions. Okay. So the next will be some value added and sharing. So everyone is exposed to forex risk directly or indirectly. For example, big companies hedge forex risk for like Apple, Microsoft, Singapore Airlines, because once they hedge the forex risk, the forex exchange risk, they can focus on their main business. They can keep on selling their goods or provide their service, just focus on their business boundary. They don't need to worry about how's the market going to run, the foreign exchange, how they don't need to worry about USD, they don't know about how Singapore dollar is going to have goes up or goes down. So for Forex offer one of the highest possible leverage available. So leverage doesn't mean risk, but if you leverage with a management, then it will be a risk. It's an advantage given to trader as well. So the way to restrict the leverage that you use is by trading smaller lot size or amount until you are comfortable with the trade position size of profit and loss. So let's go up to our new platform, Poem CFD MT5. You all can have a try on this. As you can, you can even trade CFD in our MT5 platform because right now we have already worked together with MT5. We have put in our Poem 3 things inside MT5 already. So what's the difference between Poems and MT5 if you trade CFD? The first thing will be the commission rate. You trade in Poems is standard, but for MT5 it has a lower commission rate. So for Poems, you don't have any auto close up function. For MT5, yes. But MT5, you don't have any credit limit. For Poem, yes. So for counters, they are more compared with MT5. You have more than about 5,000 counters to trade. But for MT5, we have quite less with around 200. Right now, I think you have around 300 already. So for this thing, if you all is really interesting, keen to trade via MT5, but the counters doesn't listed in the MT5 platform, you all can contact your dealer actually and request, maybe you can ask them why the counter doesn't listed. We will try to liaise with our back office, talk with them whether we can list it on MT5 or not for our client to trade. So when you want to trade the counter on MT5, please do let us know anytime. Okay. So for ledger, Poems have multi-ledgers, but for MT5 only have single, which is US dollar only. For Poems, you can have multi-currency, Singapore dollar, US dollar, or maybe Malaysia ringgit. You can have multiple currency in the account. So for one-click trading, Poems we don't have the functions, but for MT5, yes. Just one-click buy or one-click sell, your position will straight away open. So also for advanced order type, both we have. For H mod, no for Poems. For MT5, yes. So for the H mod, actually, is some add-on for you. Not that the H mod is like something like if you open a buy position for DBS, for example, if you open a long position for DBS in Poems platform, you cannot open another sell. If you open another sell 100, if you long 100, you sell another 100, you buy 100 and you sell another 100, the position will straight away close if you are in Poems website, Poems platform. But if you do in MT5, you can open in both different way. Buy 100 DBS and sell 100 DBS. The position won't close. It won't be a contra, which means you can open both opposite direction, same counter in the same time. This is what we call it as a H mode. All right. So right now, for our MT5 Forex Trade for Reward program, we do have a reward program for trading. So if until from 1st January 2024 until end of this year, and if you trade on Poem CFD MT5, you will receive an attractive reward. The reward you may refer to our website, the link below, to trade the CF to get the reward lah. There's a rebate for every trade. So if you really interesting, would like to open an account for existing client, you can log into Poems, go to account management. Under account management, there's a CFD. Then you click on the online account opening. So for new client, new customer, company can go to our website, poems.com.sg. And the step one is you have to choose the account type first, cash plus account, which is the trading account, normal trading account first. The main thing is go down to the further, the CFD. If you all can see it, the CFD there, contract for difference. Remember to tick that and then you click on continue. Or you can go to one of our PIC, Investor Center, one of our branch to open Raffles City Tower, Ang Mo Kio, Boon Keng, or maybe Toa Payoh. All right. So for funding CFD account, you all can go to account management, stocks, then online forms, then you all will see a withdrawal forms. You all can do an internal transfer from your main trading account. Let's say if you are a cash plus account right now, and all your fund is in with the main account, which is you have 10,000 there, you can do an internal transfer 10,000 to your CFD account straight away. Or you can do a payment from your bank by just scan the Pay Now QR code. Remember to put in your trading account number in the reference number, which is if your account number is 0123456, you just put in 123456. In behind of the 123456, remember to put CFD. Then the funds will straight away go into a CFD account. If you don't put it, it will go into your main account only. Right, so this 55. So this is my contact details. You all may contact me, email anything to me if you would like to know more about the CFD or any trading matters. You all can email me or call this number. Okay, so for account opening, you all can scan the QR or you want to join our Telegram group. It's right hand side. In the Telegram group, we do share a lot of market news as well. You all can join. So this is a Q&A session. Yes, MD5 only for CFD trading only. Cannot trade for normal trade like equities. No, only for all CFD. Okay. Okay, so for more handy payload questions, trading and financing charges compared with trading options. All right, so actually for CFD, CFD and option, even though it's look like quite same, but actually it's two different things. So in terms of trading charges, I can say it's mostly same the charges as I know from US there, US options broker. What I can say, I do briefly look through lah. I cannot guarantee that I look very details, but I can say the charges will be mostly the same, not much different. The charges will be quite low for trading charges, the commission charges, especially commission. Actually, for CFD and options, it's actually quite low. But for the financing charges, I do think that CFD, yes, will be slightly higher. Because for financing charges, CFD is, if I'm not mistaken, option would not be charged on the whole contract. Maybe. Sorry about that. For option, I'm not really quite familiar on that. But for CFD, we charge on the whole contract value. Let's say your contract value is $10,000, but you only borrow, maybe you open a 10,000 contract value, but your initial margin you put 10,000. Even though you only borrow 2,000, but we still charge you based on the $10,000, the value, the contract of the value, based on the contract value, not based on the money you borrow from us for CFD. So I think that the financing cost will be higher compared with option. Okay. So for Mohandi Pillay, if you keep a CFD position open for 10 days and the market goes against you, do you have to keep topping up to keep the position open? Okay, so for this, actually you don't need to keep top up to keep the position open. As long as the initial margin, you have the initial margin, the required margin, what I can say just now, the example for, yeah, show you the slide here. Okay, so I use indices as an example, the mini contract. Okay, you all can have a look. So as long as the margin requirement you have, if the fund in your account, CFD account, as long as it's above the margin requirement, let's say you open one S&P 500 USD1 for 4,300, you open, the position is buy. If it keep on go down, like let's say it go down to 4,200, the initial margin will be much more. You are required to top out the money to hit the initial margin. As long as the margin requirement, as long as your funds in the account is higher than the margin requirement, then you don't have to top up. So let's say if it goes down too further, you just put on the as what we put in the margin requirement. Let's say you put 300 only, just for the 300. So when it goes down for a bit only, then you are required to top up to 300. So when the margin requirement is 300, the funds in your account has dropped from 300. Let's say you have 300, but you lost the point against you, right? From your $300 you put in a CFD account, well, go down to about, maybe you lost about $30. become $280. Then you need to top up another $20 to cover the margin requirement. Okay. So in summary, what I can say, as long as you have enough fund to cover your margin requirement, then you don't have to top up. Even you open up to 1 year, then you don't have to top up as well. Okay. All right. So if there's no question, then I'll end my session for today. Thank you for all your time. Right. Thank you. Thank you for joining the session for today. End the session now. No problem.